Hey everyone, this is Marshall aka the Thetatrada, and in this video we'll be talking about the wheel strategy. If you haven't watched my previous videos about covered calls or cash secured puts, I suggest you pause this video and watch those. I'll probably link it in one of these two corners over here because this video is going to heavily rely on the fact that you've already seen those and you understand those concepts to really understand how this strategy is implemented and traded. So in this video we'll go over what even the wheel strategy is, how to trade it, and how it actually makes you income in 3 different ways, and basically why I think that this is the easiest strategy for new traders to get into. Lastly, we'll be going over an example of how the strategy will play out in its different life cycles. I have like a whole spreadsheet that we'll go over, and we'll look at how you'll gain income in the different ways and things like that. Don't forget to check the links in the description. I have my options trading log down there. You can see my live trades that I have open right now, as well as my full account value and things like that in there. There's a link to my Twitter if you don't want to keep that options trading log open all the time. Every time I make a trade, I post it to my Twitter, and also I retweet things that I think you guys might find informational and useful there. Also, the presentation I'm about to show you will be inside of the description as well, linked. If you like the video, don't forget to like and subscribe. It really helps out the channel. And with that, let's get into the video. So now let's look at how to trade the wheel strategy. So the first thing we're going to do is just do a little bit of recap on what selling cash secured puts are and what covered calls are. Again, I go way more in depth on these topics in my other videos, so please go check those out, but I will do a quick recap here. So selling a cash secured put is selling a put that we do not own by putting up cash as collateral. The buyer of our contract pays us the premium of the contract. If the contract expires in the money, our collateral will be used to buy the buyer's 100 shares at the strike price. And if the contract expires out of the money, the contract will expire worthless, and we get to keep all the premium from the sale of the contract. And then now let's take a look at a recap of selling covered calls. This is where we sell a call that we do not own by putting up our 100 shares as collateral. The buyer of the contract pays us a premium for the contract. If the contract we sell expires in the money, we sell our 100 shares to the buyer at the strike price of our contract. And if the contract we sell expires out of the money, the contract expires worthless, and we get to keep all of the premium of the contract. If any of that was confusing to you, like I said, please pause the video, go watch the other 2 videos until that knowledge really becomes like ingrained in your brain, because the more repetition you get of this knowledge, the easier and easier it is to understand, and the easier this strategy will be to implement. So now let's see how we can kind of like merge these 2 strategies into basically one strategy and use it to make us money. So this is basically, there's really only 4 steps to trading the wheel. The first one, we're going to sell puts on an underlying that we are bullish on and collect premium from selling those puts. Eventually, our put is going to expire in the money, our collateral will be used, and we will now own 100 shares of the underlying. So that's part 2 of the put expiring in the money. Part 3, now that we own those 100 shares, we're going to start selling covered calls against those 100 shares and start collecting premium from those covered calls. And then step 4, our call expires in the money, our 100 shares get called away, and we profit from the sell of the shares. So now let's look at a real world example of what trading the wheel would actually look like. And I set up this little tiny spreadsheet so that we can keep track of this really basic example of how this is all going to work. And so let's just go over the column headers now. Things to keep track of: what kind of option you're actually selling against. Is it a put or a call? What strike price you're selling against, what collateral you're putting up, whether it's the 100 shares or the cash, the premium that you're getting for selling that option, whether you get assigned or not, and then the share price for when you do get assigned. Another good thing to keep track of when you're doing the wheel is the break-even share price. You never want to sell a call that's below your break-even share price, because then you'll be losing money on the shares. This is also good just in case you don't want to sell calls and you just get assigned at the put and you just want to sell the shares immediately. Just make sure that you're above your break-even price. We're also going to keep track of the profits that we get from the puts, the calls, and the shares. and then we're going to keep track of our total profit for this entire wheel. So we're going to be going over a stock that I'm pretty bullish on, which is Workhorse. So let's just go back to here. The first step that we're going to do is sell puts on an underlying that we're bullish on. So if you watch the cash secured put video, we always want to sell as close to a 0.3 delta as possible. So we have this $34 strike right here, and this is almost exactly a 30 delta. So let's go back to our spreadsheet and start filling some information in. So this is the $34 strike. So since it's $34 strike, we're going to multiply that by 100, and we're going to put up $3,400 of collateral. For that $3,400 of collateral, we're going to get $369 in premium. 369. Then let's just assume for this case, so I already went a month out. 1, 2, 3, yeah, February 12th to March 12th. So I already went a month out. And let's just assume for this case that by the time March 12th happens, that we did not get assigned, Workhorse stayed above $34 that entire time. So we're going to hit no for this. So we don't need to enter a share price. So next, let's just assume that we're going to sell another put. Now, all of this, we're going to assume that we hold until expiration as well. We're not going to roll or do anything fancy like that. So let's assume this comes around again, and then it hasn't hit $34, so we didn't get assigned, and now we're going to need to sell at the 0.3 delta again, but let's assume that this 38 is now like 36 or something like that. So let's go down, and we'll say we'll do like a $32 strike. So we'll go down a few more strikes, and I'm not going to pull this out anymore because obviously I can't forward time and see what the actual prices are going to be, so we're just going to keep this at March 12th and just kind of guesstimate on what the prices would be and the deltas and everything like that. So let's assume we're down here and we want to sell this $32 put now. So our strike is now going to be $32. Our collateral is going to be $3,200, so we just released $200 of collateral right there. So we now have $200 to put into some other trade if we wanted to. Premium we're going to get for this, now this will probably be a little bit higher since in our magic scenario, the share price actually went down by $2 and we're sitting at 36. But we'll just assume that it stays the same, and this is worth $315. So $315. And let's assume this time that yes, we did get assigned. It actually hit $32, and so we got assigned at $32 a share. So we can already see that some of this stuff is kind of starting to fill in. So first, let's look at this break-even share price. Even though we got assigned at $32 a share and we paid $3,200 to buy 100 shares, our break-even share price is actually $25.16. And that's because we've already collected $684 in profit. So we could actually subtract that from our buying share price, and this is actually going to be our break even. So we could actually sell our shares at $25.16 and come out even on this trade. Obviously, that's not what we want to do, but it's nice to keep track of for when you're selling calls, or if you see the share price going down, 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 maybe it hits like 27, you're like, oh, this is kind of a situation I don't want to be in anymore. I can still sell and make a profit on this trade. So that was step 2. Our put expired in the money, our collateral was used, and we own the 100 shares. So that was step 2. So now we go into step 3. We're going to sell calls against our 100 shares and start collecting premium. So if we go back here, instead of selling puts, now we're going to sell calls. And again, we want to sell around a 0.3 delta. We're going to make up the strikes, but we are going to get at least the premium for what a 0.3 delta is going to look like. So 0.33, 0.31, 0.31, 0.31, holy cow, 0.27. Okay, so let's do the $53, because this is about as close as we can get. So $283. And let's just assume, since obviously that being $52 isn't really realistic in our example right now, so let's just assume that this is like, we're back up to $36. And so now instead of the cash as a collateral, it's going to be our 100 shares. Our premium, what did we say was a premium? $283. 283. And so now we can see a little bit more is getting put into here. Our break-even share price just dropped some more because now we've collected more premium, and now we have some call profit being put in there. We collected $283 in call profit. Our share profit's still negative $3,200 because that's how much we paid for the shares. But our total profit, even though we've already spent $3,200, our total profit's only, we're minus $2,200 now. And let's assume that we didn't get assigned again, so we don't need to enter in a share price. So let's assume the next time the stock price has went up, it's now sitting at, let's say at 35 bucks. Let's say it almost hit our strike price, but not quite. So let's say we don't think it's going to go up much higher. It's kind of losing some steam. So let's sell a $38 call. Again, we're going to put up our 100 shares as collateral. And let's go a little bit further out on here just to pretend. Let's say we went up like 2 strikes, and we're going to be sitting at around here, $251 as our premium collected. And let's assume, yes, we did get assigned at this. Yes, and we sold our 100 shares at $38 a share. So this was step number 4. Our call expired in the money. The 100 shares got sold to the buyer of our contract, and we profit from the sale of the shares. So now, if we look back at this, we collected put profit of $684. Our calls netted us $534. Our shares profited us $600. That was the 38 times 100 minus 32 times 100. And then our total profit that we got from this trade was actually $1,800, which is insanely good considering really we only put up $3,200 for this entire trade. So, I mean, realistically, you're making, I mean, that's over 50% on your money. Like, let's assume each one of these was a month to go by. You made over 50% of your money in 4 months. I mean, if you invest in just an ETF, I mean, you're averaging 7 to 9% in a year. And with just this $3,200, you've outpaced every single ETF pretty much for an entire year, several times over. So that's why I think this strategy is just so good. And then once your 100 shares go away, this is why it's called the wheel. You just start selling puts again. So now we'll go back and we'll sell another put, and let's say the strike, since it got called away at 38, let's sell a $34 strike again, and let's collect another $369. You know, put up another $3,400 of collateral. Boom, let's not get assigned again. You know, and it just goes around and around, and it just creates this wheel. So, and our break-even share price just keeps on dropping. The amount of profit that we get just keeps on going up, up, and up. So this is basically, that was basically a real-life example of how the wheel strategy can be implemented. And I feel like, you know, this is literally the best strategy for new people in the options world to get into, because it's really going to show you how much money there is to be made with options rather than just buying and holding shares. If you bought shares at $3,400 and you sold them at $3,800, which is the difference between our first and last sell, you would have made $400 in 4 months. That's $100 a month. Instead, we made $1,800 in 4 months with essentially doing the same thing, just getting paid for our limit orders is basically what this whole strategy did. So again, I can't talk this strategy up enough. I think that this is one of the best strategies that you can use if you are bullish on a stock and you want to own the 100 shares, let the 100 shares get called away. And yeah, I think it's amazing. All right, so that was the wheel strategy. I hope I made it easy enough for you all to understand, and I hope that if anyone's on the fence about getting started trading options, that this at least gave you enough knowledge and a little bit of confidence to actually dive in and start doing it. So yeah, don't forget to check the links down in the description, and like I said, like, subscribe, do all that stuff that all the YouTubers tell you to do. I don't think I have anything more for you guys, so until the next one.